There is a lot business professionals and CEOs can learn from unpacking the 25 basis points rate cut decision taken at the December meeting of the Federal Open Market Committee of the U.S. Federal Reserve Bank and the dot plot or path of interest rates movements projected. Updates from Jerome Powell also will factor in the latest analytics on U.S. inflation and how the geopolitics from a Trump administration and the global dynamics could impact the world's largest economy and, of course, the rest of the world. There are three broad areas of prime interest. First, what the future holds for the U.S. as far as the economy is concerned, which affects investment flows and sentiment in other parts. Second is how consumer prices will behave in 2025. How fast will inflation come down, if indeed it does at all? And third is the Fed reserve rate. To what extent will borrowing costs in the US diverge from Europe? Will US interest rates remain higher as Europe cost of borrowing comes down faster in 2025? As we draw the curtains on 2024, the perspective of central bank chiefs in major economic blocks helps business professionals to be better equipped for 2025. We feature in today's deep dive Jerome Powell giving his last word on the U.S. economy for 2024 at the just concluded FOMC briefing. Tomorrow, the Bank of England and Bank of Japan governors, both institutions expected to hold interest rates, will be explaining their rate decisions. Hello and welcome to another episode of Global Business Insight, where we bring perspectives and analysis diving deeper into the headlines. First, some of the main headlines moving the business markets. November UK inflation rose to 2.6% as expected, further supporting likelihood of the Bank of England holding rates steady at tomorrow's meeting. The pound also dropped slightly after the inflation read. We also saw yen weakening, with the Bank of Japan also expected to hold. November Eurozone inflation rebounded a little less than previously estimated, according to a revised data release. Year-on-year consumer price increases inched back up to 2.2% last month, a slight change from the 2.3% figure published late November. After a three-year low of 1.7% in September, Eurozone inflation has been bouncing back above the European Central Bank 2% target. The markets are abuzz as Nissan shares surged 24%, while Honda Motor stock slipped, following reports that the two Japanese automakers were potentially considering a merger and may operate under a holding company. A memorandum of understanding is expected to be signed soon. Shares in the French car maker Renault also advanced 6.5% following reports of the merger. Nigeria's President Bola Tinubu today presented the 2025 budget of restoration to the National Assembly. He applauded the resilience of the economy and reform progress, as the budget aims to spend 47.9 trillion naira, of which 15.8 trillion naira is for debt service, and the largest allocation of 4.91 trillion naira goes to defense and security. 34.89 trillion naira revenues targeted, and 3.89% of GDP deficit financing also in the budget. Inflation is expected to drop from 34.6% to 15% in 2025, while crude oil production will increase to 2.06 million barrels per day. We will in later episodes take a closer look at the details. The Dow looks set for a first 10-day losing streak since 1974 after the Federal Reserve FOMC cut the benchmark rate by 25 basis points to a new range 4.25 to 4.5% and signaled fewer rate cuts in 2025. The cuts put rates back to the level they were in December 2022, noting that one member today decided to hold rates unchanged. Today we look at the 25 basis points rate cut session of the US FOMC and all we are learning on the US economy in 2024 and going into 2025. Jerome Powell's speech gives a latest glimpse on the outlook, especially for 2025 and how 2024 went. Indeed, the US economy had outperformed Europe since the 2022 Ukraine invasion and energy shock, but even before the COVID pandemic, Europe was lagging behind the US in terms of economic growth momentum. In 2025, analysts expect the divergence to widen due to the incoming US administration's pro-growth policies driven by tax cuts, deregulation, and improved financial conditions, but with headwinds from trade wars and possibly tighter monetary policy. Ahead of the FOMC meeting in 2025, analysts saw monetary policy divergence expanding, with the Fed's terminal rate at over 4% and the ECB's at 1.5%. All this amidst the geopolitical volatility and trade-related risks, with Trump also reshaping the global landscape on issues like climate and weakening, or at least a retreat from multilateralism as World Trade Organization, World Health Organization, and United Nations recede in their global influence. Tax cuts, of course, are inflationary, and stickiness may find fresh impetus with the risk of a restart in rate hikes in the US. A resurgence in inflation may also likely act to tame policy direction in terms of tariffs as the Trump government prioritizes price stability over trade policy. Also, over 90% of central banks are exploring digital currencies, and Bitcoin has spiked over 40% since the US elections. All this signal faster acceleration to a more digital environment. The response to Trump's tariffs threats will of course depend on yet to be clear specifics on the what and how of tariff threats. Some, like Mexico's president, have warned of reciprocal tariffs, while others, like ECB President Lagarde, has pushed for negotiation and the purchase of more US goods. China will most likely straddle both positions as it accelerates its independence from the West in terms of critical materials and technology. But broadly, the old United States, as Democrats may have wanted it to look like, may not be coming back, and the rest of the world does not expect it to. Sectors expected to be stars in 2025 include the expensive technology, AI sector, the undervalued financial services, and the always well-positioned defense-related stocks. Oil and gas, still a question mark, and cyclicals could be cheaper cash cows. A revival of domestic-focused industrial policy is already at play as Trump and the CEO SoftBank Group, Masayoshi Son, announced over $100 billion in U.S. projects over 4 years. The IRA and CHIPS Act could be tweaked to catalyze domestic growth in tech-based industries, and this aggressive use of U.S. policy may force recalibration of policy and reform, especially in Europe, in need of a fresh catalyst for growth. But let's listen to a clip on what Jerome Powell had to say today after the final FOMC meeting in 2024.
Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year.
Markets expected a hawkish rate cut with a lot of caveats around more uncertainty than normal with an incoming administration with a lot of policy uncertainty. Not surprising was the cautious response of reduced number of cuts projected in 2025, as we now see in the dot plot, with 2 cuts next year instead of 3 or 4 rate cuts previously. Also, in today's summary of economic projections, that's the SEP, 2024 GDP was raised up from 2% to 2.5% and 2.1% in 2025. Unemployment forecast is down to 4.2% in 2024, and core PCE inflation surprisingly revised much higher to 2.8% in 2024 and 2.5% in 2025. In short, it's a better US economy than we thought, but with sticky inflation. So what are CEOs and business professionals learning here? In 2025, irrespective of the region, all need to be extra prepared for geopolitical twists and turns, if not the occasional shock, and positioned to benefit from recalibration of global trade dynamics with clear contingencies proactively mapped and linked to identified triggers. Higher inflation and higher interest rates for longer in the US in 2025 could mean higher borrowing costs, of course, for dollar borrowers in Africa like Nigeria, Kenya, Egypt, Ghana, and South Africa, as well as more imported inflation. Investment / capital flows also will favor US markets if yields in the US remain high. In our next episode, we will consider the Bank of England decision and the update coming from the governor. Well, that's all we have on today's episode for Global Business Insights. I want to hear your comments on how you see the global economy in 2025. Thank you so very much for watching. This is Bode Oshosani. Bye-bye.